Wait, what? Over the past few months, I've been scrolling through YouTube and seeing the same thing everywhere. Financial channels telling you to buy this, hold that, prepare for the crash with these 5 magic assets. Everyone sounds so confident, so logical, so absolutely certain they have the answer. They're all wrong. Well, most of them anyway. Look, I'm not here to attack these creators personally. The problem isn't that they're trying to deceive you. The problem is they're using outdated playbooks for a completely new game. And when that happens, even good advice becomes dangerous. You've probably felt it too. That quiet unease when you're watching these videos. Something feels off, but you can't quite put your finger on it. Everyone's giving you lists of safe assets, but deep down you know this time feels different. Here's what's really happening. We're living through the easiest time in history to generate convincing financial advice. Ask any AI system what assets perform best during a financial crash, and it'll give you a clean, reasonable answer based on historical data. Cash, government bonds, defensive stocks, real estate, precious metals. The list looks smart. The arguments sound logical. The problem is the assumption behind it. AI assumes the rules stay the same. It assumes the system functions like it always has. But that's not how history actually works. History doesn't move in straight lines. It moves in regimes. And every few decades, the regime changes so completely that yesterday's wisdom becomes tomorrow's disaster. To understand why this matters, we need to look backwards for a moment. Not to repeat history lessons, but to see how survival strategies actually evolve. Every major financial crisis had a primary driver. The Great Depression was about leverage and speculation. The 70s were about inflation and oil shocks. The dot-com crash was about technological speculation detached from reality. 2008 was housing leverage and banking excess. 2020 was an external shock followed by unprecedented money printing. Each time, the system broke in one main place. And each time, investors learned new rules. Cash matters. Bonds are safe. Liquidity is king. Hard assets protect you. These lessons were real, earned through pain, and they worked in the next cycle. But here's what nobody tells you. Financial theory is always written after the damage is done. The rules that always work are usually rules from the previous war, not the next one. What we're approaching isn't built around a single failure point. It's systemic. That word gets thrown around constantly, so let me explain what it actually means. A systemic crisis isn't one thing going wrong. It's multiple systems weakening simultaneously, feeding into each other, removing your usual escape routes. We're entering a setup where government debt is at record levels, interest rates are high and sticky, banks are fragile beneath the surface, commercial real estate is under severe structural stress, and political decision-making is completely unpredictable. Add in speculative excess, driven by artificial intelligence hype, and a global system still dependent on one dominant currency. Individually, each issue is manageable. Together, they change the entire game. This is why resilience needs to be redefined. Most people think resilience means an asset that doesn't fall much, or recovers quickly, or worked last time. That definition works in normal recessions. It fails completely in systemic stress. In a systemic crisis, resilience isn't about price stability. It's about survival under pressure. Can you access your capital when others can't? Does your purchasing power hold? Do you depend on intermediaries behaving rationally? Do you still have choices when forced selling dominates? Keep that definition in mind, because it's the key to everything that follows. And remember this, there is a solution. There's one asset that fits this definition perfectly, but to trust it, you need to see why all the others fail first. Let's start with cash, because it feels like the obvious, safe choice. Cash gives you psychological comfort. You see the number in your account, it doesn't fluctuate daily, and it feels like control. But cash carries 2 risks most people never separate: purchasing power risk and access risk. Purchasing power risk is silent and deadly. Your balance stays the same, but what that balance can buy keeps shrinking. Over the last few years, central banks proved something crucial. When the system faces pressure, they will inject massive liquidity very quickly. Call it quantitative easing, emergency lending, or stabilization tools. For someone holding cash, the result is identical: more currency units chasing the same real goods and services. This isn't just a domestic problem. The dollar sits at the center of global finance. When it gets diluted, inflation exports worldwide through trade, energy pricing, and supply chains. People in completely different countries feel rising prices even when their local policies didn't change much. Then there's access risk. Your bank balance isn't physical cash sitting in a vault. It's a claim on a bank. Banks function well when confidence is high and assets are liquid. They become fragile when large asset classes start cracking. Commercial real estate is one of those cracks forming right now. Vacancy rates are historically high, valuations have dropped, and a massive volume of loans needs refinancing at much higher interest rates. When refinancing fails, banks don't need to collapse to create problems. They just need to protect liquidity. Credit tightens, movement slows, access becomes conditional. Cash isn't useless, but it's not protection. It's a tool that can cut both ways. Now, government bonds, traditionally the ultimate safe haven. For decades, investors believed sovereign debt from strong nations was risk-free. In many cycles, it was exactly the right place to be. But risk isn't only about default. Risk includes inflation, credibility, liquidity, and policy behavior. Today, sovereign debt levels are unprecedented. Interest costs are enormous and rising. New debt keeps being added while the yield curve has been inverted for an extended period. This means short-term lending pays more than long-term lending. This isn't optimism about the future. It's the market saying the near-term environment is dangerous and intervention will likely be required later. Add geopolitical precedent and unpredictable policy decisions. And government bonds stop being purely financial instruments. They become political instruments. In a systemic crisis, confidence is fragile and precedent changes behavior. Stocks come next, including defensive ones. Yes, defensive sectors often fall less in typical downturns, but systemic crises aren't typical. When liquidity dries up and forced selling begins, correlations spike toward one. Everything gets sold, not because fundamentals suddenly collapsed, but because capital is being pulled back everywhere. Defensive stocks are still equities. They don't protect capital when liquidity disappears. Real estate feels safe because it's tangible and familiar. It has worked for decades. But real estate prices are set by credit conditions, not by how solid a building feels. When rates rise and refinancing breaks, forced sellers appear. In this cycle, commercial real estate adds a structural layer of stress that feeds directly into banks and credit markets. Real estate becomes an amplifier of crisis, not a shelter from it. Commodities are often described as inflation hedges, and that can be true in certain environments. But crashes are usually demand shocks first. When demand collapses, commodity prices fall sharply and volatility increases. They don't provide stability when liquidity is the primary problem. Cryptocurrency is often presented as being outside the system, but in practice, it behaves like a speculative asset driven by leverage, sentiment, and momentum. When confidence is high, prices soar. When conditions tighten, forced selling accelerates losses. FOMO turns into panic much faster than people expect. Crypto may have a future, but in early phases of systemic stress, it behaves like a high-risk asset, not a shelter. Silver gets grouped with safety because it sounds similar to gold, but structurally it's very different. Silver has significant industrial demand, higher volatility, and much deeper historical drawdowns. In crises, it falls harder than most people are emotionally prepared for, especially when speculation is already elevated. For inexperienced investors, it becomes a trap disguised as safety. At this point, something should be crystal clear. Every traditional safe haven depends on something staying functional: liquidity, policy, credit, confidence, or behavior. When all of those are under pressure simultaneously, capital runs out of places to hide inside the system. This is where the solution begins to take shape. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. There's one asset that doesn't depend on a bank remaining liquid, a government honoring a promise, or policy framework staying predictable. Central banks understand this, which is why they've been increasing their exposure to it. Large investors understand this, which is why they quietly accumulate it during uncertainty, not for returns, but for protection. When other safe havens fail, capital doesn't scatter randomly, it concentrates. And concentration creates powerful price dynamics. At the start of a crisis, this asset can fall 5, 10, even 15%. That initial drop isn't failure. It's the system pulling liquidity out of everything at once. The difference is what happens next. While other assets continue weakening under debt, credit, and confidence stress, this one stabilizes, recovers, and appreciates as trust in the system erodes. It drops less, recovers faster, and preserves your ability to act. That's why it has been held as money for thousands of years. That's why central banks still hold it today. And that's why, in a systemic crisis, it becomes the final refuge. That asset is gold. Gold isn't someone else's liability. It doesn't require permission. It doesn't default. It doesn't get diluted. It doesn't depend on confidence in institutions to retain value. This isn't about hype or predicting exact timing. It's about understanding what survives when the rules change fundamentally. Look, I know gold feels counterintuitive right now because it's near all-time highs. People think if it's high, it must be late to the party. But gold isn't priced like a growth asset. It's priced like monetary insurance, reacting to confidence in the system, debt sustainability, and real interest rates. In prior crises, capital had multiple credible destinations that actually worked. Long-duration government bonds, strong currency positions, and general belief that policy credibility was stable. In the current setup, many of those destinations are compromised by debt, inflation risk, political risk, and market structure. When you reduce the number of credible shelters, flows concentrate into the remaining shelter, and concentrated flows create stronger price moves. This matters because gold doesn't just preserve value. It preserves your ability to act. If you hold something that retains purchasing power while others are forced to sell, you become the buyer when opportunities appear. This is the crucial mindset shift. The goal isn't to win the crash. The goal is to come out with enough purchasing power and liquidity to buy quality assets at discounts when the crowd is forced to sell. The entire safe haven conversation is really about preserving optionality. The people who build lasting wealth in every crisis are the people who can act when everyone else is trapped. Now, let me give you a simple framework you can use without being a finance expert. Phase one of any crisis is liquidity, forced selling, and correlation spikes. Many things drop together even if they're fundamentally different. Phase two is policy response, fear of debasement, and repricing of trust. That's where monetary assets and system outside assets tend to shine. Phase three is opportunity. Once forced sellers have sold, quality assets get discounted and people who preserved liquidity can buy. Your job isn't to predict the exact timing. Your job is to hold something that can survive phase one without collapsing and be positioned for phases 2 and 3 without being trapped. Most people don't lose in crashes because they chose the wrong asset on a spreadsheet. They lose because they panic at the wrong time due to not understanding the mechanism. If you understand why cash loses purchasing power, you stop worshiping the bank balance as safety. If you understand why government bonds carry fiscal and policy risk, you stop assuming risk-free means no risk. If you understand why defensive stocks are still equities, you stop expecting them to save you in systemic shock. If you understand why real estate is credit-driven, you stop thinking tangible automatically means safe. If you understand why crypto is behavior-driven and leverage amplified, you stop confusing hype cycles with safe havens. If you understand why silver is a volatility magnet, you stop letting social media push you into trades you can't emotionally hold. And if you understand why gold is a monetary asset outside the system, you stop judging it like a tech stock and start using it like insurance and optionality. This isn't about being a gold fanatic. It's about being intellectually honest about what survives when liquidity dries up and rules change. The real danger isn't the crash itself. The real danger is thinking you're safe in a place that only works in normal times. Traditional safe havens can fail because this is a multi-factor regime shift, not a clean textbook recession. Gold isn't exciting, and that's exactly why it works. In crises, boring assets with no counterparty risk become powerful. The winners in every crisis aren't the people who predicted it perfectly. They're the people who prepared correctly and had the discipline to execute while others were forced to sell. So while everyone else is following outdated playbooks and making the same mistakes, you now understand why this time truly is different and why there's only one asset positioned to not just survive, but thrive when the traditional safe havens fail. The question isn't whether a crisis is coming. The question is whether you'll be ready with the right shelter when it arrives. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.